Play. We are working on a technical problem with the audio. If you guys can hear me, please just type anything in the chat. Okay, good. All right, great. Thank you. All right, today we are going to be explaining the moving average strategy. We are going to be talking about everything related to the moving average. We're going to be explaining. Good morning, everyone. We're going to be explaining the moving average, the different types of moving averages. We're going to be talking about how to use it in your trade, the different paths and different strategies and techniques to use the moving average. Today with you, my name is Gabi Dahdou. I'm the Chief Market Analyst in One Trading Markets. I am a certified financial analyzer with fundamental and technical analysis degrees and risk management and fundamental 101. So let's talk about the webinar content today. The first thing we're going to be talking about is what's the moving average, the types, the top used time frames for the moving averages, how to use the moving average in your trades, crossovers, and types of crossovers. So let us begin our webinar. Our webinar won't be taking a long time, between 30 minutes and 45 minutes roughly. Let us begin. So what is a moving average? So a moving average is a simple technical analysis tool that smooths out the price data by creating a constantly updated average price. Now, what does that basically mean for us? Let me show you here with a simple example using Paint. Yes, you heard me, Paint. You're gonna see me draw. So let's say we have a chart, okay? Okay, another one here. This is our chart. So basically, as you guys know, the top one here represents our, actually, let me just draw like this better. Okay, this represents our value for the whatever you're analyzing, whether it was a stock, currency, gold, oil, cryptocurrency, it's always going to represent the value. And this line here, the horizontal line, will represent our time frame. Okay, so let's say we're trading on a daily time frame. So each one of these lines represents 1 day, 1 day, 2 day, 3, 4, 5. And here's going to be our value. So when we want to analyze and find a moving average for a specific chart, let's say on the first day the chart was at $1, second day was $2, third day was at $4, for example, fourth day was at 3, the last on 5th. So we want to basically understand what is a moving average. So we calculate the tops and bottoms and we divide them. What does that basically mean? So we have 2 tops and 3 bottoms, for example. So we add 5 and 3 and we divide it on 4 to 1, which gives us a certain point. This point will be the start of our moving average. And while we go every day adding another day, this line will draw another line, then another line. If we connect all of them, it will be our moving average. It seems complicated, but you're gonna see it's really simple. So let's look at it right here. Let's just leave this for now. Here we go. So notice our chart here, okay? Each candle represents, for example, 1 hour. And we want to calculate the moving average for 10 hours. So we're going to be calculating on 10 candles because each candle represents 1 hour. So we calculate these 10 candles and we see how many days the candle actually closed above the average price, how many times it closes below the average price, and we divide them and we get this line right here. If you guys can see it, this is what is a moving average. Now, if you guys have any question, by the way, just please make sure to ask them. There's a tab on the right. It's a bubble with a question mark in it. I'll make sure to answer each and every one of you. If you have any questions so far, just please let me know. Okay, keep going. So we have different types of moving averages. By the way, the moving average, before we continue, I've known a lot of traders in my life. I'm an experienced trader. I've been in the business for more than 10 years. Everybody uses moving averages as part of their strategy or their main strategy. They're really helpful. They help you understand how the market is moving, how to anticipate your profit, your stop loss, everything basically. So the main three types for the moving average are the simple moving average, which is basically what we just said. Everything I just said was a simple moving average. The second type is the exponential moving average, or EMA. The third type is called the weighted moving average. So this is what a simple moving average looks like. This is the moving average on a euro yen on a 1 hour chart. So each candle represents 1 hour. Okay, fairly simple, no problem still. So let's talk about the exponential moving average. Now, why do we need different moving averages? So here's the thing with the simple moving average. When the market moves rapidly, like it goes up really fast or it goes down really fast, the moving average doesn't have enough time to react to how the market is moving, which causes a problem. In trading world, this problem is called lag. And this is where the EMA comes to help us. It basically tries to solve that lag problem by creating a moving average that moves quickly than the simple moving average. It's basically the same principle as the simple moving average. It just gives more weightage to the recent price action. So if the market goes up really rapidly, we see the EMA moving faster than the simple moving average. So let us look at an example here. It's the same chart. So the black line is the exponential moving average. The brown line is the simple moving average. Now notice right here how the market started moving up really fast. Okay, and notice how the black line started moving as well faster than the brown line. This is basically what the exponential moving average does. It helps us solve that lag problem. Same here. Notice on our example right here. Let me show you. Let me put my laser pointer. Okay, if you guys can see it like this. So notice here. Notice how the market dropped suddenly. Like in a matter of 4 hours, it dropped from 129,675 all the way bottom to 128, basically 700. So notice how the black line it reacted faster to the market dropping, while the simple moving average, it took it time to tell us what's going on with the market. And that's basically what an exponential moving average is. It basically helps us to understand the market more quickly, faster basically, and it gives us signals, which we're going to be learning soon on how to use this strategy while you trade. The third type is called the weighted moving average, or WMI. Now, let me explain it to you like this. Think about the weighted moving average as a hybrid car. Okay, it has a diesel engine and it has an electric engine. So the weighted moving average basically combines the features from the simple moving average and the exponential moving average. So, but the problem is not a lot of people like using the weighted moving average for reasons, to be honest, we cannot explain, but you can actually use it. It's a valid strategy. Most people prefer to use simple moving average and exponential moving average, but we had to mention it because it is a major part of this strategy. This is what it looked like. So the brown line is the simple moving average, the black line is the exponential moving average, and the purple line is the weighted moving average. Notice how the weighted is always reacting first, then the black line, then the brown line. Same here. WMA first, EMA black the second, and simple moving average third. Do we have any questions so far about the types of moving averages? Yeah, sure. I can tell you. Yeah, sure. I'll explain that. So, like I said, what's the difference between the simple and the normal moving average, or the simple moving on the exponential moving average? When the market moves really fast, rapidly, it creates a problem that's called lag, where basically the moving average doesn't have the reaction. It doesn't react with the market really fast, and that's where the exponential moving average helps that problem. You notice here, let me show you the example again. This is the simple, this is the exponential moving average. Notice how the exponential is reacting faster than this simple moving average. All right, so let me show you a live example actually on this and how it looks like. So let's go into our trading platform right here. So this is our trading platform that we use in One Trading Markets. So the beauty of it, because you can add any indicators, which is basically a moving average, an indicator to any chart, and you can actually see it on the chart. So you just go into your indicator tab right here, and you just search for a moving average. It's under trends and moving average. So it gives you settings as well. So do you want to use the simple? Do you want to use the exponential, the smooth, or the weighted? The smooth, basically nobody uses that one, but let's go with the exponential moving average. And you set up the time period here, like 10 candles, 20 candles, 30 candles. It's up to you. We're going to be talking about time frame pretty soon. So let's go here. Good. Okay. And here we see the moving average with the chart. This is what it looks like. So let's go back into our webinar here. And now we're going to be talking about the time frames for the moving averages. Okay. Top used time frame for the moving averages are 5 days, 10 days, 20 days, 50 days, 100 days, and 200 days. Just let me be clear about something. When I say days, you gotta assume that we're talking about a daily chart. A daily chart basically represents each candle represents 1 day. But let's say we want to analyze an hourly chart, which is basically each candle represent, for example, here. This is a 1 hour chart. If you can see here, here is where you set the time frame. This is a 1 hour chart. So here we are looking at the last 20 candles. This is what I mean by 25, 10, 50, and 100 and 200. It always looks at the candles before. It's not certainly days, but if we're looking at a daily chart, it will be days. Okay, so here are, let's go back here. Okay, maximize it. So 5, 10, 20, 50, 100, and 200. A lot of people also use 14 because it basically represents the week, but the top use are these. So now we're going to be learning on how to use the moving average in your trades. So there are two main ways or two main strategies to use the moving averages in your trades. The first one is crossovers between the market price and the moving average. Now, what does that mean, basically? If you look at an example here, we noticed how the moving average, let me get my pointer, laser pointer, okay. We notice here that our moving average is basically crossing with the market. So this is the market, and notice how the moving average is going above, and here is going below, here is going above, like the market's going above the moving average, the market is going below the moving average. Now, what does that basically tell us? This is where we get our buy and sell signals. So there is a rule in moving averages. Whenever the market drops below the moving average, it basically indicates that we're having a bearish move. Bearish means the market is going down. And whenever we have the market going above the moving average, it basically means that we're having a bullish trend, which basically is the market going up. So let's look here at our examples. Notice how the market was in a bearish move, and we noticed here how the market crossed above the moving average and started trading above it. The moving average in the bottom, market is above. That basically gave us a buy signal that indicates that the market is having a bullish trend right now. So for example, if we actually bought here, we could have ridden this wave all the way back, all the way up to here. And this is where our stop loss will be. Do you see what I mean when I say take your profit and stop loss? It helps us identify when to get into the trade and when to get out. We noticed that the moving average, you can't hear me? Sorry, I just got a question. Can you guys hear me? If you guys can hear me, can somebody just type anything in the chat, please? It should be working. Yeah, okay, he can, okay. So they can hear me. It's probably a problem from your end. So could you please check at your end? I will have another example here for you, don't worry, in case you missed it. So this is basically our go into the trade. This is where we start our trade. We keep holding the trade until we see the market crosses below the moving average. So this is our stop loss. So we would have won all the way up in this trade, but notice how there's always some lag, right? Like the market did drop a little bit. So we're not maximizing our profit, but we're basically playing it safe because technically the market could go down one candle like here and keeps going up. So only when we see the market crossing below the moving average, we can understand that the trend is ending and we're changing from a bullish trend like here to a bearish trend. Now let's look at our example right here. This is a big example. Basically, this is a 1 hour chart. So we roughly have like 40 or 50 candles here. So this is basically 2 days. This is a trend that lasted 2 days. We noticed here that the market crossed above the moving average, which is basically our buy signal where we go into the trade. So we entered the trade here and notice how the market is moving up. Now, our first sell signal will be around here, right? Because we noticed how the market actually crossed below the moving average, where we made our profit. Then we noticed again how the market crossed again. We go in back, then we stop loss here. Basically, we exit the trade here, and again, and again, and again, and again. And this is basically this is the first method of using the moving averages. Is basically to understand how the trend is moving, because the moving averages is a trend following indicator. It basically tells us how the trend is going. Is it going up? Is it going down? Is it going sideways? This is how we use, this is the first method of using the moving average. Does anybody have any questions so far on how to use the moving average, the first strategy on how to use the moving average? Yeah, of course. So like I said, the rule is when the market crosses above the moving average, it's a bullish sign. Bullish means that the market is going up. So when the market crosses above the moving average, it's a buy signal. And when the market crosses below the moving average, it's a sell signal. It's always going to be like that. That's always a rule. You're going to see it all the time. Let me actually show you a real life example on how this looks. This is the moving average. Notice here, if you can see, this is where the market crossed below the moving average. We sold here and the market went down. This is where it went sideways. Notice how the market is moving with the moving average. We noticed that the moving average crossed here and started trading above. We bought here, we hold this trend all the way here, then we sold here. This is how we make our profit using the moving average. I hope that was clear. Any other questions? Okay, let's continue. Get my pointer here, laser pointer. Our second main method of using the moving average is crossovers between different moving averages. So this is where it gets a little bit complicated, but we're gonna see right now. I'm gonna explain it in a way it's gonna be super simple. Sorry, I just got a question. Can you use them when scalping for long periods? 100% you can. You're gonna see examples here on crossovers that actually lasted years. 100%. I'm saying years. I'm not even saying days. Like there's days, there's weeks, you can even use them when you're trading for 15-minute chart, 1 hour chart, weekly chart, monthly chart. You're going to see exactly how this works right now. So crossovers between different moving averages. Okay. This is the golden rule that you always got to remember. By the way, moving averages crossover can help you identify when to get in and get out, like we said. And moving average crossovers occurs when two different moving averages cross over one another. So you know how we talked in our first method, how the moving average is crossing with the market? Now we're going to see how different moving averages cross with each other. And here is the example. So we have here exponential moving average for 10 days and an exponential moving average for 20 days. Okay. Notice how they cross in this example here, in here, here. So the rule is, the golden rule that I told you about is always when the short-term moving average crosses above the long-term moving average, that's a buy signal. I'm gonna repeat it again because it is very important. When the short-term moving average crosses above the long-term moving average, it's a buy signal. Now, why is it buy signal? It basically represents how the market is actually increasing in value. Like the short term basically represent the last 10 hours, for example, here on our example. The long term represent 20 hours. So in the last 10 hours, the market was gaining more momentum. It's gaining more action. There's more demand or supply, which basically caused the market to add value. Now notice here, look here at our first example. Notice how the short, which is going to be the black one, the black line, and the long is going to be the blue one. Notice how the black line crossed below the blue line, representing that the long term is stable more than the short term, which basically gives us a sell signal. So at this crossover, if we sold here, notice how this wave actually dropped down all the way here. So it basically dropped down from the 129,374, if you can see here, all the way to the 128 to 100. That's basically 1,100 pips. Depending on what size are you using for your trade, this could be a huge profit. Now, we noticed here how the short term crossed above the long term. And not only that, notice how the trend, like the market itself crossed with the moving averages. So see how we use two different strategies together? Like even here, notice how the market crossed below the moving averages and we had a crossover. So this basically gives us a confirmation on the trend. It confirms to us that the trend is actually 100% changing direction. So it's a very good chance for us to make profit in these trades. Same here, the market went above the moving averages and we had a positive crossover. A positive crossover is what we call when the market is moving bullish, by the way. So we rode here like that. Notice here they touched, but nothing actually happened because the short-term moving average kept going up. We rode all the way up here. This is where they actually changed direction again. This is basically when we understand that the bullish trend that we're actually gaining profit on is changing. So now it's time to gain from the bearish trend, which is basically by selling the product that you're using, whether it was stock, cryptocurrency, whatever it is. Any questions so far on this strategy? I hope everything was clear so far. Okay. I see no questions, so I'm guessing this was clear. Okay. So let's look at the types of crossovers. This is where I told you that we can use them for years. Hold on, I just got a question. I see that the moving average crossovers lag more than the price and MA crossovers, which is bad. So the best way to actually use them is to use both of the strategies together. Now, why is that basically? Because it gives us a confirmation. It confirms the move. So there's no such thing in trading that's called 100% strategy. but there is indicator that helps us understand the market and profit from that understanding. So we noticed, like in our first strategy, how we understood that if the market is below the moving average, it's a bearish signal, correct? Now, if we add moving averages crossovers to it, it's like adding strawberries to ice cream. You can't make it worse, you're just making it better. You're identifying the trend, you're confirming that the signal is real 100%. Well, nothing's 100%, but you know what I mean. It basically helps us better understand how the market is moving. But the lag, the one I told you about, it's basically, how to explain it? So the lag creates a problem for us to enter the trade. Now notice here, like how the lag actually reacts with the market. Now this is on the EMA, so there's no lag here, but this is the thing. Let me show you here. So the lag creates a late opportunity for us to enter a trade. This is what the problem. When using the exponential moving average, it gives us an early signal so we can make more profit. So we can take advantage of the trend, not go into the trend late. That's basically it. All right. Let's talk about the golden cross and the death cross. Now these terms, what do they mean? Let's start with the golden cross. So a golden cross is a crossing of two moving averages. My pleasure. Two moving averages, which is basically indicates that the trend will go bullish. Remember when I guys told you about the golden rule, right? Like 2 minutes ago, which is basically when here, you guys can see it, when the short-term moving average crosses above the long-term moving average, it's a buy signal. And this what represents for us a golden cross. It basically tells us that the short-term moving average crossed above the long-term moving average, which caused us to understand that the trend is changing from bearish to bullish, and it's time for us to buy. Now, the golden cross, we call it golden cross. We usually use it with the 50 moving average and the 200 moving average if we're checking the major trend. This is where I told you about years of actually profits. People understanding that the golden cross happened creates a great opportunity for us to get in and buy. So let us see an example right here. This is on the Euro USD daily chart, okay? It happened in 2017. Notice here, this is the 200 EMA, and this is the 50 EMA. We noticed here, there is a golden cross happening. So we waited a couple of days to see if the trend is actually pulling up. And we noticed that the trend is actually gaining more momentum. This is where we set up our stop loss, by the way. So it's not very far away from where we started, but just to help us minimize our risk. You always should trade with stop loss, remember that. So we bought right here. Notice how the trend actually lasts, like how long did the trend actually last? It lasted from May 2017 all the way to May 2018, a whole year. When do we usually exit from a trade like this? Now, I know most people don't trade this long, I understand, but for example, people who trade in stocks or in cryptocurrency, they can actually hold a trade for like a year or two or 3-4 months, especially if there's a golden cross happening. We only exit the trade when the short-term moving average crosses below the long-term moving average. This is basically our confirmation sign that the trend has ended. Now, of course, you can get out here before all of this happens, because you can see how the moving average right here is losing momentum and it's getting closer. But when do you have confirmation that this bullish trend actually has ended? Only when another crossover happens here. And this basically brings us to our death cross. What is a death cross? A death cross is a crossing of two moving averages, same as the golden cross, but it's a technical pattern indicating the likelihood of prices to actually go in a bearish turn. So it's the opposite of a golden cross. So it happens when a long-term moving average, which reflects the major trend direction, rises above the short-term moving average, which reflects the recent prices. So let's look at our example right here. This is another example on the 4-hour chart for the USD Canadian dollar. Notice right here that we have noticed a death cross happening. This is the 200 exponential moving average. This is the 50 exponential moving average. We see the trend actually dropping down. Okay. Now we waited. Okay, this is a 4-hour chart. You can always wait. You don't actually have to get in right away when you see a death cross or a golden cross. It basically gives you a confirmation that the trend is strong and that you'll most likely make profits from your trade. So we waited, and let's say we got in around this area. We notice here how the market went up above the moving average, but the death cross is still active. What does that basically tell us? It shows us that the market is having a correction wave, or what we call it in trading, it's taking profit. Let me give you an example. So when you buy a house, let's say for $1 million, okay? You live in that house for a year, and the next year, your house is now worth $1.5 million. Does that mean you have $1.5 million? No, it doesn't. You have the $1.5 million only when you sell the house. Now, in that profit, what happened is basically what we call making profit. This is the phase where we make profit. So people, let's say, for example, sold here and they exited their trade here, which basically they cashed out their profit. And this is what basically is correction waves in the trading. So notice how the trend is still bearish, but there are small waves where people actually exit their trades and take their profit. It basically shows us that people actually exited the trade earlier than they're supposed to. Some people don't want to take higher risk, which is understandable. So let's continue with our example here. So we notice how the trend is keep going down. And let me ask you one question to see if you guys understood me very well. When do we exit this trade? Let's say if we sold right here, okay, right here. When is our confirmation that the trend has changed from bearish to a bullish trend? Can anybody actually answer me? I believe you. I know you can. I know you can figure this out. That is correct. Exactly. When we see a golden cross. Same here. Do you know how we said we enter the trade right here? We exit. We know where the trend has changed direction when the moving average is crossed. Same here. So we entered our trade around this area, and we know when the trend actually changed direction is when the EMA and the 50 EMA and 200 EMA actually crosses again. That's precisely right. Let's look at a real life example and see how this actually works out. See if we can find any moving averages. So this is a 1-hour chart. Let me just remove this indicator so we can add another one real quick. So trend, moving average. Let's go with the 50 and the 200. You don't have to use the 50 to 100. You can actually use like the 10-20. You can use the 50-20, etc. So 200. We might not see a big golden cross, but we will check. Let's put this in another color. Let's go with blue. Okay. See, on the hourly chart, we don't see that much sign. We see one here, which is gonna basically help us. So let's move this to a daily chart. Okay, here's a daily chart. So like I said, this is our long term. This is our short term. We notice a death cross happening here, which basically gives us a sell signal. So we waited for the confirmation. We seen the market is actually dropping down. So we sold here, let's example. And notice how the market actually kept going down. It actually reached 1.12, 444, all the way from 1.19. That's huge profits we're taking, because every drop, every move is a potential for you to actually make profit, to enter a new trade, to exit a new trade. This is, you see a correction wave, you bought, you see a downtrend, you sold. This is how we use the moving averages. It's very simple, it's very easy, and it's very helpful. This is why I'm telling you 100% of all the traders that I met in my life, everybody uses moving average. You can use this strategy alone, or you can actually add it to another strategy. Like in our last webinar, we talked about candlestick patterns, which is also another strategy. And in my next webinars, you will see also different strategies. I'm going to be trying to conduct a webinar every 1 or 2 weeks to help you understand different strategies and see what suits you best so you can use it and make profit and minimize your risks. Do we have any questions about the moving average strategy at all? Anything. If anything is unclear, just please don't be shy. My job here is actually to help you understand the strategy. For short trading, what time frame do we use? Okay. So short trading, what do you exactly mean by short trading? Do you mean like on a daily basis? Like if you open a trade today, you want to close it in a couple of days, or you want to open a trade today and close it in the same day? What exactly do you mean by short trading? 30-minute chart. Okay, let's look here at a 30-minute chart. This is the 30-minute chart. So we can't look at the 250 here because they're too long. We can basically use the 510. So the 5 exponential moving average, the 10 exponential moving average, or we can use the 10, 20. For example, let's delete these. Come on. Here we go. Moving average, let's use the 10. And let's use, for example, the 20. Actually, yeah, the 20. See, even the 10, 20 actually gives us signals. A crossover here, a crossover here. Let's look at it earlier. I haven't actually set up the colors for them, so let me. So this is the 10. We're gonna make the 10 red. Okay, and this is the long one. It's gonna be blue. Notice here how this crosses over. Okay, let me just remove this. Where is it? There we go. This. Okay. So notice here how the crossover happened in this area. The market was moving sideways. Then we had a confirmation that the crossover happened here. The longer moving average is above the lower moving average, the short-term moving average. The market is below the moving averages. We know it's a sell signal, and notice how the market actually dropped. We kept riding this wave. See, we kept riding this wave until we had another crossover. This is where the market basically moved sideways. Have you seen the market is moving with the moving averages? And this is where we had another crossover, but it was bullish this time. The short term went above the long term. We rode this wave. We had another moving average indicating a bullish trend. We sold, and this is how we use them basically. It's very simple, very helpful. I hope that was clear. Somebody says you don't have the buttons for making trends. Do you mean on our platform? You should be able to see all the buttons. If you don't see the buttons, you can probably hit view. See, and you can add actually, like it should probably be here. But if you don't see them, if you go to insert on the top right, the top left, sorry, you can see indicators and you can add them to your chart. And by the way, you can customize the chart as you want. Like, for example, let me show you. Let's say I want to open a new chart. It's going to be looking like this. You can customize it, make it whatever different colors you want, and you can save that customization. See, I have mine saved right here. Basically shows me the chart like this. Any other questions? I hope I was clear with everything. I hope you guys actually learned something here today. This is a very, very good strategy. It's going to help you understand different charts, different products. Like I said, the beauty of the strategy is that you can use it with different products. So stocks, currencies like Forex, commodities where you're talking gold, oil, lumber, cryptocurrency even. Like even if you look at here, our platform, for example, let's look at Bitcoin. Oh, sorry, it was at the beginning. This is Bitcoin USD. We add moving averages here, 20, 10, let's make it red. See? Crossovers, crossovers. This helps you a lot to actually minimize your risk and make the best out of your trades. If there are no other questions, I've been Gabi Tatu today with you. This is my Instagram where I post daily news and daily updates about different markets, Forex, stocks, whatever you want. My Telegram where I post detailed analysis on different products that I analyze. And I hope everything was clear with you today. And I look forward to seeing you in our next webinar. We're still deciding on what it is going to be, but we should have you updated in the next few days. So if there's no any further questions, what is the minimum deposit? This is basically a sales questions. I have technically no idea, doesn't evolve about my work, but I can have somebody from the sales team, or I can have our manager account actually contact you and tell you all about it. But if I'm not mistaken, I'm not very sure about it, but it should be very minimum. It's basically to help people understand the market. And we're doing this webinar to educate people to see, like, it's not really that hard to try. You got to invest in yourself, learn a little bit, and you'll be making profit very soon. If there are no other questions or comments, then you'll have a very good day, and I'll see you guys in our next webinar. Take care. I see your question, and also this is, I will have one of the sales team or an account manager contact you, and they will actually tell you all the information that you need to know. All right, guys, have a good day.